Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. And let's get you up to speed on the market action. An hour to go in the trading day. We're still looking at a mixed picture. It's been a pretty choppy trading session. Right now we have the Dow just below the flat line, off about 0.1%. The worst performers inside the Dow: Goldman, Walmart, and 3M. All three of those stocks off just about 1%. You look at the S&P trading to the upside, up just about 0.3%, coming off 2 straight weeks of declines. And then you're looking at the Nasdaq, the leader among the three major averages, as big tech is really outperforming in today's trading action. The Nasdaq up just about 0.6%. Let's take a look at some of those big individual movers. And first, we got to talk about U.S. Steel. Shares there soaring in today's trading action on the possibility of a future buyout. We're looking at gains of just about 40%. Now, the company rejected a $7 billion plus offer from rival Cleveland-Cliffs over the weekend, but making it clear that it will consider, quote, strategic alternatives, saying that they do have multiple offers here. And Akiko, lots of things to discuss, everything from the reaction in the stock price, at least today, to, of course, possible antitrust concerns if we do see a deal, if Cleveland-Cliffs actually is able to pursue U.S. Steel. That, of course, would combine two of the major leaders within this space. So whether or not it would get approval here from regulators is something that investors would then think about down the line. But certainly, judging from the market's reaction, and Cleveland-Cliffs CEO saying that this does prove that, at least in his eyes, they view that this offer that they did make for U.S. Steel as reasonable.
Yeah, I mean, if this deal does go through, and that's a big if, this would mark a real dramatic shift within the steel industry overall, going from 4 giants in this space to 3. I thought it was interesting how Cleveland-Cliffs CEO kind of framed this, obviously talking about the interest in U.S. Steel, but also saying he wants to create a national champion. And Shauna, to me, the interesting part of all this is sort of the context of what this looks like internationally. When you think about if these two forces were to join hands here, how they would compete internationally at a time when China has really dominated the steel market here. Steel prices have seen a big run up in the U.S. on the back of those import tariffs. But if you think about all the giants globally, China really up there. If U.S. Steel and Cleveland-Cliffs were to combine, they would be number 4 globally, would certainly be a huge powerhouse, at least being able to compete internationally. But it's interesting to see some of these moves here. And we'll have to see if this really does turn hostile, because Cleveland-Cliffs CEO making it very clear they are still very much interested here, want to keep that conversation going with U.S. Steel. Well, PayPal finally has a succession plan. Intuit senior executive Alex Chriss will become the next president and CEO effective September 27th, replacing current CEO Dan Schulman, although we should note Dan Schulman will remain director of the company until May of next year. You see the shares up to more than 2.5%. When you think about where the stock has gone, though, Shauna, I mean, we're talking over the last few years from a peak of $360 billion to today, roughly $70 billion. This is a company that has a lot of challenges ahead of them, with competition coming from the likes of Apple Pay, as well as the slowdown they're seeing in Venmo. But interesting to see the company choosing from 9 candidates there. Alex Chriss emerging as the top or the next CEO. Yeah,
we'll be talking to an analyst in the next hour, and he's actually taking the view that he thinks he is a good fit here for this leadership position. So we'll hear a little bit more as to exactly why here in just about an hour. But Akiko, you're exactly right. PayPal up against some pretty stiff competition and massive underperformance as of late from PayPal shares. There certainly seems to be, at least in the market today, a little relief now that a new CEO has been named. We know that PayPal has been searching for a replacement of Schulman now for several months. But a number of factors here. One, the competition, obviously softening consumer. A challenge here for PayPal, at least in the immediate term. And we know the company has been undergoing cost-cutting efforts now since the start of the year. It did announce earlier this year that it did have plans to cut 2,000 jobs. So it's a challenging story, but like Dan Dolev said over at Mizuho, it's not an unfixable story. So we'll see whether or not Alex Chriss is able to turn things around and get some of that momentum back. All right, and this week, all eyes turn to big box retailers. Target, Walmart, Home Depot, TJX, all reporting earnings this week. We'll get a closer read on the consumer, and also ahead of those results, Evercore out with a new call here when it comes to Walmart, adding it to its outperform list. Walmart shares did hit a record high earlier in today's trading action, now off just about 1%. But Akiko, Evercore making the argument that they're expecting a beat and raise quarter and saying what we have talked about several times here on the program, just given the position and given the priority that Walmart has placed on the value of some of their pricing when it comes to their goods, it gives them the edge in this type of environment.
Yeah, and it's not just about, sort of what we have known as traditional Walmart customers. What's interesting is how Walmart has been able to expand their market share. When you think about the higher income customers as well, it is about what we said last week, sort of the focus on fresh foods, less discretionary spending, which you could argue, sort of works against the likes of Target. But also, I thought it was interesting, this note that came out from Guggenheim talking about the alternative revenue streams that Walmart is likely to see. We're talking about places like advertising as well as healthcare. So not only are they performing strongly, or the expectation is that in this quarter they continue to perform strongly in their core, they are seeing other tentacles that are driving in additional revenue. So 52-week high today on the stock. We'll see if it goes even higher when those numbers come out.
We will see. And of course, we will be covering this and a lot more. You're not going to want to miss our week-long special Retail Evolution. The new era, Yahoo Finance is going to bring you expert analysis and insights from leaders in the industry to help you make your investing decisions in this space. We got you covered all week right here on Yahoo Finance.
Well, concerns mounting in China as their economy continues to run into new issues. Following President Biden calling the economy a ticking time bomb, one of the country's largest private developers, Country Garden, hit a record low after reportedly looking to restructure its debt. It comes as another shadow banking giant raised fears after missing payments on several high-yield investment products. For more on what this means for U.S. investors, we want to welcome in David Sequeira, Morningstar Chief U.S. Market Strategist. David, it's good to talk to you today. Mm-hmm. It does feel like those red flags that a lot of analysts had warned about before in China are continuing to pop up even further. You're talking about the real estate market, the debt that's been happening there, and then concerns around shadow banking, which I feel like we've been talking about for years. How are you looking at all those latest headlines coming out in the context of the slowdown that we've been seeing in China, or slow growth we've been seeing in China?
Mm-hmm. Well, the first thing I think you have to remember is that the direct impact to the U.S. economy from China is actually relatively limited. When you look at the amount of exports from the U.S. to China, it's still a pretty small part of our economy. So I think really the impact is going to be, mostly concentrated within a handful of companies, specifically technology companies that have a lot of restrictions in what they're allowed to be able to export, into China. A couple of companies that I'd be concerned about there would be like NVIDIA. That's a company that, while it has great growth prospects, we think it's just run up too far in price. It's currently rated 2 stars. It trades at about a 40% premium to our fair value, as well as a lot of the semi-equipment suppliers. ASML would be another one where a lot of those restrictions are really going to hamper their ability to export some of their higher end. But really more important with China, I am very concerned about the weakening in consumption. I know our analysts over there have highlighted that, and as you mentioned, the real estate valuations are at risk. We actually recently cut our fair value on Country Garden. I think it was last week. And we expect, the Chinese economy, not only is it going to slow for the second half of this year, but we think it's going to be slowing over the next several years. I know we're looking for GDP to slow down to a 3% growth rate by 2027. And of course, that can have, a negative impact on the consumption and economy. And those companies that are most tied to it would be companies like Apple, Tesla, and Nike.
Dave, does this at all change the projections here in the U.S., given some of the concerns that we're seeing globally, specific here in China? Because at least when it comes to the U.S. as of late, that soft landing has certainly been the dominant market narrative. Is that still intact?
It is, and that's been our forecast since the beginning of the year. We've always been in the no recession camp. Now, having said that, we're looking only for 1% GDP growth here in the third quarter. And in fact, we do expect that the rate of economic growth will continue to slow sequentially for the next 3 quarters and won't bottom out until the first quarter of 2024. So again, our base case is tight monetary policy, decreasing lending. It will all take their toll on the economy. However, we do expect inflation will also to continue to moderate. We think it's going to drop down, should be 2% next year, in our view. So we do think that by the beginning of next year, maybe even as early as February, we expect the Fed's going to reverse course and start cutting interest rates.
What was that timeline again?
So we'd be looking for the beginning of next year, probably in February is when in 2024. So the Fed could start cutting interest rates.
Let's talk about what we got in the news we got in the steel industry today. U.S. Steel soaring on news. It rejected a $7.3 billion buyout proposal from rival Cleveland-Cliffs and is exploring strategic alternatives. We've got news now that Esmark has announced they have offered a deal to buy U.S. Steel shares. As we were saying earlier, we have seen a big run up in steel prices, partly because of the tariffs, but also because of this expansion we've seen in manufacturing coming through from the IRA. What's your outlook in the sector, and to what extent are we likely to see the ripple effects coming from this?
Well, if we're looking at M&A specifically, it has been really slow as far as mergers and acquisitions in the first half of this year, between rising interest rates, making buyouts more expensive, in the funding markets, like the levered loan market being relatively tight. We've seen M&A on the low side, but we do think it's actually poised at this point to start ramping back up. In fact, we expect the M&A will probably increase over the next, 6 to 18 months. And listening to a couple of the investment banker conference calls, I think they're calling for the second quarter to be the low for M&A. So when I think about it from a strategic point of view, if we're right and the economy does slow the next couple of quarters, that of course then leads to slowing organic growth rate. You could see management teams, looking for acquisitions in order to bolster their own growth. But then also looking at the private equity market, PE sponsors still have over $1 trillion in dry powder that they're just itching to put to work. And if you look at, some of the valuations, I know according to PitchBook, private equity valuations are still down 20% from their highs. So I think that's all going to line up, for a good M&A in the second half of this year and into next year.
David, what does that mean for the markets more broadly speaking? How big of a catalyst is it going to be a catalyst at all?
I don't know if it's going to be much of a catalyst overall. The market is up over 17% year to date, following this strong rally. When we look at the broad market, it's only trading at about a 4% discount to our fair value. Of course, it was at a much, much lower, valuation at the beginning of this year. So I do think looking forward with the economy slowing, I expect returns to be much more muted over the remainder of this year. In fact, I think now is a really good time, especially while things are relatively slow and quiet in August. Take a fresh look at your portfolio. I think now is a good time to start selling, lock in some of those profits on stocks that have run up so much that they become overvalued, overextended. Nvidia would be one that I would highlight. Netflix, Oracle would be a couple that we think are overvalued. And I'd look to reinvest those proceeds. Look for those stocks where they're undervalued, they're unloved, they have lagged the market rally. Two I'd highlight there would be like Medtronic and Kellogg.
What are particular sectors that you think have been overlooked?
Well, the communications sector, by our numbers, is still the most undervalued sector, even though it's up, I think, about 40% year to date. It's trading at a 20% discount to a composite of our valuations in that sector. Alphabet is still rated 4 stars, even if, as much as it is, year to date, trades at a 20% discount. But we also still do see a lot of value in more of the traditional names there. Two that have certainly been in the news the past couple of weeks, AT&T and Verizon, both, have seen, kind of market sentiment turn against them with some of the lead sheathing and potential environmental liabilities. But we think the market's overestimating those liabilities. Both those stocks are rated 5 stars. They trade at a 40% discount to our fair value, and they're paying a healthy 7% dividend yield.
David, retail is going to be one of the big focuses of the market here this week. We will hear from a number of big names, Walmart, Home Depot, Target, among the companies that are set to report. What's your read right now on the strength of the consumer and whether or not that resilience narrative that we've heard in the past quarters, whether that's going to continue here this time around?
Yeah, the consumer for the past 2 years has just been under a lot of pressure with inflation well outpacing wages. That did turn the corner earlier this year. I'm just not sure if the wage increases have really gotten high enough at this point yet to really turn the corner yet. So there's 3 things I know our consumer team is going to be listening for this week. One, are we still seeing a shift in spending into grocery and away from goods? Are we still seeing consumers trade down into private label from branded label? And are people buying fewer items per trip? And if the answer to that is yes, then I do think that the consumer, still is under pressure.
And with that said, any particular names that you're watching in terms of retail? We were talking about the big run-up that we've seen with Walmart, just given the value play, and now they've continued to bring newer customers into the fold.
Yeah, so one I would highlight reports end of this week is Estee Lauder, and I think that's going to give us good insight into upper end consumers as well as the global consumer. Now that stock ran up way too high during the pandemic in our view. It did hit a 1-star rating. It began sliding in 2022, and it's still trending down at this point. And I think a lot of that's just because of concerns on the post-pandemic recovery in China has been pretty slow. But at this point, we think that the stock is sold off too much. It's rated 5 stars, trades at a 34% discount to our fair value. And our analytical team actually recently added that to our best ideas list. I spoke with our analyst there, and she noted that the challenges here she think are cyclical and not necessarily structural. And she also highlighted for long-term investors, she thinks it has really good growth prospects. Emerging markets, I think are about 1/3 of their revenue base.
David Sekera, Morningstar Chief U.S. Market Strategist. Good to talk to you today. Appreciate the time.
Thank you.
We're just getting started here on Yahoo Finance Live. Coming up, Tesla shares lower today as the car maker once again cuts prices in China. We're going to break down the price wars in the EV space. Plus, concern over China's economic recovery pressuring oil prices. We'll detail the latest crude awakening for consumers. And retail is the talk of the town this week. We continue to preview what to expect from the big names in the sector. That and much more when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Shares of U.S. Steel jumping today on the possibility of a buyout. We're looking at gains of just about 38%. Now, the U.S. Steel production company, Esmark, announcing just in the last hour that an all-cash offer for U.S. Steel has been made at $35 a share. Now, this follows U.S. Steel's decision over the weekend to reject a $7 billion plus offer from rival Cleveland-Cliffs. Now, the news coming as M&A activity has declined, falling more than 28% in the first half of the year compared to 2022 levels. So for more on what all of this means for future deal making, we want to bring in John Chirico, head of banking, capital markets, and advisory at Citi, along with Yahoo Finance's Ali Garfinkel. Great to see you both. So John, would love your perspective on the interest that we're seeing in U.S. Steel, what this says more broadly speaking, maybe, or what we could expect in terms of activity within M&A.
Sure, Sean, it's a pleasure to be here. I think it's indicative of the theme of trying to create resilient supply chains more than anything. The idea of a domestic champion that can participate in steel and provide folks an opportunity to buy U.S. steel is, I think, what's driving that. We've seen tremendous hostile activity, unsolicited offers, and at this point in a cycle from an M&A standpoint, it's not that big a surprise. Clearly an interesting asset, lots of other shoes that are probably likely to fall before it ends, and we'll see how it plays out.
John, and you speak with a number of CEOs across industry landscape. When it comes to this potential deal or the activity that maybe we could see with U.S. Steel, when you're talking about a potential tie-up here with Cleveland-Cliffs, very, very far out from that deal being done. But what are you hearing just about the risk of antitrust and how executives are looking at this and the likelihood of some of these major players being able to acquire other large players within the space?
Yeah, it's a major consideration. I think, having a bit more stability in that area, I think, would really help the M&A market, much more so than concerns about financing being part of the issue why things are down. I think at the moment it's more about clarity on how transactions would be viewed. Now, in this case, clear, a lot of this production is outside the U.S., and so it's probably a bit less of a concern here. Mm-hmm. I think it's really going to be about which is the proper suitor that makes sense, and whether U.S. Steel choose to go it standalone or sees their future better set to be part of a bigger company.
And John, another area where we're starting to see some chatter again after kind of a long silence has been IPOs. Full stop, right? Is the IPO market reopening?
It's always reopening, but it's definitely on a trend. I think we've had a few transactions this year already get very, very strong support. What we're seeing is folks really preparing for the back end of the year. 24 is where we would expect to see a real uptick, but we think there's going to be real opportunities towards the end of the year. And when we tend to focus on the large names, everybody thinking about the big brand name, large cap companies, but the bread and butter of the IPO market is that $200 to $400 million IPO that's potentially a $2 billion, $3 billion company. And I think but we're probably looking at the first half of next year, maybe into the second quarter, until we're back to a steady state level that really works. It's been really difficult up until this point, so we're happy to see the few transactions come through, and I think we will see more before the year ends.
And kind of to that end, as you're thinking about IPO volume, should we be imagining 2021 levels, or is it something different?
Yeah, I think 2021 was a bit of an anomaly, and because it was as big as it was, I think that's what causes the flame out. I think anyone who's in this business and is thinking about it, long term, we'd like to see markets that feel a bit more like 2018-19, and where the IPO market is fairly balanced. We also like a market where it's a bit of a stock picker's market, where it isn't macro themes opening and closing markets. So we need some stability on the backdrop politically, economically, and that's again why we think 24 could really be back to a stock picker's market and one where the IPO market could really thrive and be broad.
John, there's been lots of focus in recent weeks on ARM IPO, what exactly that's going to look like, the likelihood of when we're going to see that go public. When you take into account some of the hurdles, some of the challenges that these companies are facing, given the macro environment, given the fact that we could be in this higher for longer, higher interest rate environment, to what degree do you see that maybe keeping some of these companies on the sideline for a bit longer than maybe we had initially anticipated?
I think that's what's been occurring over the last 18 months. I think particularly when you think about a company like ARM or some of these large cap companies, it clearly could become public whenever it chooses to be. And it's going to be able to have a very good opening when it comes. I think it's more the issue of what's been a valuation reset in tech, and we're starting to see it was building back. It's given a little bit back in the last week. But that back and forth around valuation is a bigger issue rather than true existential sustainability. I think if I think about private companies, they've had great access to private capital over the past year. But the real question now is, do they go it alone and go public, or do they think about M&A as a potential way to become part of a larger company as they move into the future? I do think in 24 we'll see folks go public, we'll see folks sell themselves, but you'd want a little bit more valuation stability where it isn't 1 week it's up, 1 week it's down. And so again, I think the second half of the year is going to give us some of that stability as we build into 24.
And John, I'm going to stick with tech. You said that we're in the midst of the great tech reset. What does that mean, and what should investors be looking out for?
Yeah, so look, technology and growth overall, because within what we call tech, whether it's it's industrial tech, or it's in healthcare and it's healthcare IT or tech, I think the growth verticals within our large verticals are always a very interesting place to focus. And so growth, while it may be out of favor or was out of favor over the last 18 months from a valuation perspective, long-term has to be in favor for investors. And so I think the key for these private companies has been, how do I maintain my growth while private? And I want to be sure that I don't destroy long-term value by ultimately constraining growth too much. I think they've done an excellent job of that, but 24 is going to be, we will be going into 24 months for some of these companies where it's been more difficult to finance. And so I think we will see folks make decisions that are more strategic around that.
All right, well, John Chirico, great to get your perspective on this. Head of Banking, Capital Markets, and Advisory at Citi. And of course, our thanks to Ali Garfinkel as well.
Thank you.
Well, shares of AMC tanking today after a Delaware court approved a merger between AMC and AMC preferred shares. Yahoo Finance's Ali Canal has the breakdown. And Ali, that is an ugly number there. The stock down well over 30%.
Well over 30%, was down as much as 34%. We're 30% down right now. You'll see in that two-day chart just how steep this decline is. Of course, this all centers on investor concern that there's going to be further share dilution of that common stock as APE shares are converted. And according to an SEC filing, there will also be a 1-to-10 reverse stock split. So every 10 shares that an investor holds will now be just one share, although it will operate at a higher value. APE shares will stop trading officially on August 25th. Now, of course, AMC, it's a volatile stock. Year to date, we are down about 14%, about 15% there. You'll see that peak in February, which interestingly enough happened after the stock conversion plan was seemingly delayed due to a preliminary injunction hearing. So basically the opposite of what we're seeing right now. But AMC CEO Adam Aron, he's consistently maintained that the stock conversion plan was essential for the company to improve its cash balance heading into 2024 and 2025. I want to read a quote from him. He said, AMC should now be able to raise additional equity capital. We can use this access to equity capital to shore up our cash reserves, pay down debt, invest in growth initiatives to strengthen our operating profitability, and pursue transformative merger and acquisition opportunities. Now, the good thing for AMC is that they recently had a very successful weekend with Barbenheimer, that double feature of Barbie and Oppenheimer at the end of July. That's going to be reflected in those Q3 results. And speaking of earnings, on August 8th, we did see that AMC beat on both revenue and earnings estimates. In fact, it was the first quarter since Q4 2019 that AMC did not report an adjusted loss per share. However, that revenue still lacked 2019 levels. And when we take a look at foot traffic at AMC, attendance is still down 30% versus 2019. So we're not out of the woods yet on this stock. There are currently 0 buys on the street, 3 holds, 6 sells. Wedbush did say that the resolution of this conversion plan, of this court contention, that eliminates some of the overhang moving forward. But that right now, AMC is still a pretty overheated stock. They have an underweight rating and $2 price target. So we'll see where AMC goes from there. But certainly investors not too happy today.
Yeah, still a long way to go until they return to those pre-pandemic levels, at least in attendance.
Yes.
Ali Canal, thanks so much for that. Well, coming up, some retailers are facing several headwinds, including wage growth, inflation, and a cautious consumer, while others may be headed for a much-needed turnaround. We're going to break down the latest retail reality on the other side.
Tesla shares falling today, off nearly 2% after the company cutting the prices once again in China, this time lowering the price for its Model Y. Pras Subramanian is following this story for us. And Pras, you got to think the reaction, at least in shares today, maybe some fears, and some of its competitors, some fears that this could maybe be the start of reigniting that EV global price war that we have seen play out over the last several months.
Yeah, that they started in China and abroad. So we saw today on their Weibo account, they cut the prices of the Model Y, both the long range and the Model Y Performance, by 14,000 yuan. You see the price changes there, about 4.5% for that long range and 3.8% for the Model Y Performance. So those are some pretty big cuts there. Also, they announced for the base Model 3A, 8,000 yuan insurance incentive for that car for people buying that base car. So this is happening after they just signed this EV price truce. Tesla and a number of other Chinese automakers signed a truce saying they're not going to do these unfair price cuts. They want to maintain competition there. Very strange to see Tesla do that, but they seem to be reneging on that deal. So that's kind of interesting to see there. And also, I think it kind of hints that potentially they're seeing some demand erosion in the mainland, and they need to go back to these price cuts to get more volume. Meanwhile, they're going to lose margin because of that. So that's kind of an issue there for them.
Pras, we got another big headline in the EV space. Shares of Nikola down, seeing steep losses today after the company announced a recall of the battery electric semi-trucks it's made to date. What are the details behind that?
So first off, they recalled about 209 of these battery electric tray Class A commercial trucks. These are basically the bulk of what they've made so far for these battery trucks. They recalled them, voluntary recall, working with NHTSA on that, and they said that they're halting sales of current trucks too, those current battery electric trucks, as they figure out what's happening here. So this all stems from a battery fire at their Arizona plant that happened in June. Nikola thought that it was arson was a reason, but after investigating it, they determined that there was a coolant leak in the battery pack that caused a fire. It's a single supplier that provides this part in the battery pack, so they've narrowed it down, trying to figure out how to actually resolve this issue with these trucks that they have on stock, and also trucks that are out in the wild. They say that trucks can still be used by organizations, by operations, but they can't actually. They should probably store them outside while they await sort of results and an actual field resolution for these trucks. So not good news there, but Nikola is in the midst of a transformation to go to hydrogen fuel cell electric trucks they want to do. Those trucks are fine at the moment, so sort of an issue here with their legacy battery trucks.
And we're seeing that concern reflected in the stock price today with shares under some pressure. Hey, Pras, thanks.
Well, names such as Party City and Bed Bath & Beyond have fallen into the growing list of bankruptcy filings, pointing to the challenging retail landscape. Retailers continue to face several headwinds, including wage growth, inflation, and a cautious consumer. But while some retailers may be headed for a much-needed turnaround, others have managed to flip the script. As part of Yahoo Finance's week-long special Retail Evolution, the New Era, we'll be digging deeper into the world of retail turnarounds. Here to break it all down for us, we have Pulse Ratings CEO Dennis Cantalupo. Dennis, good to talk to you today. You say that the key here is maintaining a healthy balance sheet and liquidity. I mean, it seems easy enough, but that hasn't been the case in the retail space. What kind of turnaround are we talking about?
Yeah, so, very often, and like you said, it seems simple, but it's what happens in the years leading up to a down cycle. Retail is very cyclical, and you're going to go through ups and downs. It's those retailers that are careful with their money in the years leading up to whatever downturn you're looking at, are the ones have a better chance of turning things around. And when I say, the ones who are not engaging in aggressive share repurchases, the ones who, if you're having a good couple of years, you don't just go ahead and give all that money back to the shareholders. You put it in the bank where you reinvest it back into your business. Those retailers that go through a leveraged buyout, that makes it a lot more difficult. It reduces your financial cushion. Those who will maybe overexpand are going to have a harder time with the turnaround. So you want to give yourself as much of a financial cushion as possible. Things aren't always going to be great. Like during the pandemic, there were a few retailers that did very well from some pandemic tailwinds. Some of those retailers bought back shares right away. And we just encourage retailers from a credit perspective, just to hold on to some of that cash when you have it, because it's not always going to be as good, and you could use that money in the future. And a great example of that, I think, is what we saw at Bed Bath & Beyond. Bed Bath & Beyond, for the period of between 2011 and 2021, they bought back almost $9 billion in shares. The business, going back that far, generated over $5 billion in free cash flow. So they were still generating quite a bit of cash flow. But because they were more aggressive in their share repurchases than they were in reinvesting that money back into their business, it really reduced their runway for a turnaround. And ultimately, they ran out of money and ultimately liquidated. So had they reinvested a good portion of that $9 billion back into the business, we believe they'd be here today and probably in years to come.
Dennis, who are some companies that got it right, that maybe you had been a little bit concerned about heading into the pandemic or in the midst of the pandemic, that were able to navigate, which has certainly been a challenging environment, pretty well? Sure. There's a couple of retailers that come to mind. Both had been the subject of leveraged buyouts, which is always a credit concern. One of them is Academy Sports, which heading into the pandemic, the balance sheet was fairly leveraged. We had them as a D credit rating. And they had high leverage. Same-store sales were kind of sluggish. The margins were in the EBITDA margin mid-single digits. When the pandemic hit, the consumer behavior changed quite a bit, right? Those people who were social distancing, a lot of them picked up new sports and activities, going outside. So a lot of the sporting goods category did very well during the pandemic. And Academy rode that momentum into an IPO. The balance sheet is a lot more healthier than today than it was then. We have them as a B credit rating now. So they took advantage of favorable turn of events, but they're also executing better, better merchandising. In their case, we saw that Walmart and Dick's Sporting Goods exited certain hunting and firearms categories. Academy was able to take advantage of that. So I would say it's twofold. One, they took advantage of a good opportunity, and they executed well during that time. So you need a little bit of luck sometimes, and certainly the pandemic was a tragic event, but it did serve as a tailwind to a few retailers.
So that's the positive in some of those retailers. But as you point out, there are still plenty of retailers that have compromised credit profiles. What are the names that you're particularly watching that you see could be at risk?
Yeah, the ones that come to mind, we have Big Lots, Joann stores, Rite Aid, Kirkland's, AMC, which I think was mentioned on the previous segment. These retailers are, for whatever number of reasons, in the case of Big Lots, we're seeing significant same-store sales erosion. We expect that to continue when they release second quarter results in the next couple of weeks. They have negative EBITDA over the last 12 months. Liquidity had become a growing concern, but the company was able to close on a sale-leaseback transaction, which generated $210 million or so in net proceeds after they paid down some mortgage debt. So that's, in our opinion, that gives them some time to kind of right the ship. We believe that in the back half of the year, there's an opportunity for margins to stabilize at Big Lots. They were pretty promotional at the end of last year. And then hopefully the operations stabilize and they turn the corner in 2024. But the sales contraction is a concern. And one of the things that I think that's really impacted not only Big Lots, but a lot of retailers who sell discretionary items to, and they market the category into that middle to lower income demographic, those shoppers have been really squeezed by inflation. They pull back on discretionary spending. So those retailers in particular have felt the brunt of the pullback, and they're going to have to figure out a way to get through it. In the case of Big Lots, they were able to monetize some assets that bought them some time, but they pulled that lever. Now they may not have as many levers to pull in the future, so they're going to have to start reversing the cash burn. Hopefully we'll start seeing EBITDA turn positive and then stabilize that liquidity.
Dennis, is there anything else, maybe more broadly speaking, that we can gather from some of your lists here? Because you just mentioned Joann stores, one of the companies that you're worried about, or it's on your radar in terms of potential troubles here going forward in the public markets. In the private market, you also pointed out Michaels. Does this tell us anything just about the specialized retailer and what that landscape could look like going forward, given all of these massive challenges?
Yeah, I don't want to paint them all in one broad stroke. The case of Michaels, they went through a leveraged buyout during the pandemic. They were levered up. They were sold probably at a premium. Right, their operations did very well in the early parts of the pandemic because a lot of people were doing more arts and crafts at home. They were making homemade masks. And since then, operations have deteriorated, and their bonds are now trading below par, which is a reflection of the bond market's general concern of the company's leverage and their ability to grow out of that debt.
All right, Dennis Cantalupo, thanks so much for breaking all of that down here for us. Well, coming up next, crude oil prices have been rising now for 7 weeks in a row, pushing gas prices higher. But what does that mean for the Biden administration? We'll discuss on the other side.
Crude oil prices have steadied today after rising for 7 straight weeks, pushing gas prices higher. Much of that's been dictated by global demand, but those higher prices are putting pressure on the Biden administration at a time when inflation is starting to cool down. Yahoo Finance's Rick Newman has more. And Rick, there are questions about how this could all play out if things reaccelerate in inflation.
I think the Biden administration has to get very nervous when they see gas prices approaching $4 a gallon. And I think, gasoline prices punch above their weight in terms of consumer psyches. And I think it actually makes a lot of difference what that first number is on the price. If it's a 3, it's probably okay, even if it's in the high 3s as it is now, around 385. If it's a 4, I think it's very bad, even if it's 401. And of course, it got all the way up to a little bit over $5 on average last summer. So the problem with Biden is that he's really struggling in terms of voters' attitudes toward his handling of the economy. And that probably is largely because of inflation. And among inflation, gasoline is the price that it's more visible to consumers than anything else. So I think Biden has to be worried about this. There's a really interesting irony here, Akiko, which is that the Energy and Information Administration, the EIA, said recently they think U.S. domestic crude oil production is going to hit a new record high by the end of this year or by sometime next year, and we are already at record levels of natural gas production. So the two biggest fossil fuels, oil and natural gas, the U.S. is either at record high levels of production or perhaps about to get there. And the problem for Biden is he can't really just come out and say this. He can't come out and brag and say, hey, we've had more drilling under me than even under President Trump, because, of course, he's trying to appeal to environmentalists and he's pushing hard for the green energy shift. And he's got this huge act with the 1 anniversary of this huge bill from last year that established all these green energy subsidies. So Biden has gotten the additional domestic oil that he was hoping for around this time last year. I just don't think he's going to get any credit for it.
Yeah, it's a tricky message he's had to navigate, we should say, over the course of his presidency, trying to really sort of seeing both sides, or at least seeing the positives on both ends, depending on which side you're trying to appeal to. Rick Newman, as always, thanks so much for that.
See ya.
Concern over China's economic recovery pressuring oil prices today. We had crude pulling back after recording 7 straight weeks of gains. Despite today's pressure, though, oil still holding above $80 a barrel, and demand expected to remain at high levels for the rest of the year. So where are prices headed? We want to bring in Bill Baruch, president of Blue Line Futures. Bill, it's good to see you again. So here we are, just above $82 a barrel. Lots of forecasts out there about rising demand, the fact that it's not going to stop anytime soon, at least for the next several months. What does that mean for crude prices?
You know, they're hanging up pretty good. I think the real underpinning right now is first Saudi Arabia and Russia. They've come through and cut production. They continue to at least do that for at least another month or two from this sort of secondary cut. Data at the end of last week also showed that Russia did cut another 50,000 barrels per day. And that got them in line with where they're supposed to be producing. There was a lot of fear that Russia was going to be overproducing. And although China's weakness is front and center, the Chinese yuan weakening because of that, it's really weighing on the metals complex. It's weighing on energy too. But thing is, China continues to import crude at near record levels. So, you know, they're despite the weakness, despite the slowing growth, they are there right now. I think the fear would be if we continue to see weaker and weaker growth, that would taper off. However, I'm on the other side of that trade, and I think that China picks up a bit, and this is some of the worst news being priced in.
Yeah, I mean, Bill, having said that, what do you make of the reaction to some of the news that we've gotten from China on the economic front? I mean, it was just last week we heard from the IEA saying that China's demand has surprised to the upside, and yet there seems to be this constant concern that kind of percolates into the oil markets about how strong that recovery looks like.
Yeah, I mean, that's why we had oil markets at near multi-month highs and setting near multi-month highs. $83 was really an upside target for us. That now we're going to see the market consolidate a bit, and I think tonight's deluge of economic data is going to be crucial. We have fixed asset investment. What we need to see, though, is really some stimulus to help get them off the ground. And I think we could be close to hearing something. Obviously, the hanging property fears, Country Garden, the news again from them was weighing on sentiment coming into the U.S. hours. So there's a lot of things here that are boiling. But you know, at the end of the day, the best and most simple way to look at it and what all this means is the Chinese yuan. And the CME Group has a Chinese yuan contract. It's the USD CNH. So it shows as it rises, it's melting higher right now. It means the dollar is strengthening against the Chinese yuan or the renminbi. And it's back at levels going back into the early or late part of 2022, was it? Yeah. And that was that's basically them exporting deflation. If they're exporting deflation, I mean, ultimately their currency purchases less commodities, and crude's been able to muscle through things because the U.S. growth is remained steady, and the demand from China remains steady. But the metals complex has been pretty ugly, because of it.
Bill, what's your outlook for U.S. production? We just had Rick talking about that just a moment ago. We have certainly seen a recovery. Obviously, oil producers want to capitalize on the rise that we have seen in crude prices. But what do you think that future growth, how much growth could we see within that?
Yeah, I think right now we're starting to see that production pick back up. And you got to think about it from the producer standpoint that, that multiple times in the last couple of decades, as we see production pick up, the prices go higher, production comes back online, and it races back online. I think right now is a unique position where you have Saudi Arabia pulling back production. You have Russia in the situation that they're in and actually following through with some cuts, although there's more, probably in the supply. But right now, I think the fact that it is a unique position where prices have come off, they've consolidated very well, and I mean maybe these energy companies could really hedge pretty well, but they're able to produce here at these levels and really not disrupt the price because of what OPEC's done and trying to be a bid under the price ultimately. So I think here you're getting the Permian has been producing quite a bit more. If you go through some of these earnings reports from these companies, like Chevron is producing the Permian at their highest level. So I like to look at it as some opportunity for these companies and investing in companies that have low cost Permian assets or good margins in the Permian, because that's where that's where the production is going to come from. But also at the end of the day, the entire space has seen tremendous underinvestment, and that's what's going to be the longest driver, steadfast driver in higher prices, because there isn't been much investment. And your prior segment, you're talking about a Biden, in the Biden administration not really being able to talk about the production coming back online because it's sort of against a lot of the narratives they've discussed. But really, the production it's because of those narratives is we've seen the underinvestment, and that's what's going to underpin prices. And if we get steady flows from the Permian and other places here from these companies, I think it's not going to disrupt price. So that's where I really like a lot of these energy stocks right now.
Bill, that raises the concern what this all means for these energy companies, particularly big oil names, for their trajectory moving forward. I mean, we're talking about where oil prices are, but as you said, that the long-term trend is underinvestment. ExxonMobil themselves have talked about sort of low carbon being a big driver in the future. I mean, how do you look at that side of the investment? It feels like that was more front and center last year in terms of conversation, but those investments are continuing in the back.
Well, last year was a reality shock. When Russia invaded Ukraine, it really was a reality shock that energy runs the world. It really does. If you look at every product, from lip gloss to keychains to just different things that you see around. The plastics, I mean, shoes, bottom, soles of your shoes, everything is coming from petroleum. So, and I think that became a big reminder in how important petroleum is not only in what producing the products, but heating your home and, going from place to place and fuel. I think that was a reality check. And the fact that how quickly those costs drove higher, everybody realized it's an inflation problem if there's this much underinvestment and the world is not ready to move away from it. So I think, again, that was a reality check where we came into this year or came from last year coming into this year. And now you're starting to see production come back online. There's incentives for some production to come back online. But again, coming back to a lot of these companies, if you look at a lot of these, if you sift through the earnings reports, one of the themes was the revenue's down, but these companies were beating earnings, though the revenue's down because of the price of oil. Now, if the price of oil goes higher, these companies, the margins are going to increase. The free cash flow is there. It's going to increase. I think these companies have put themselves in a tremendous spot, and they're not just flooding the market with oil. They're bringing it back. And that really brings me to the resource life of these assets that they're drilling. I mean, the resource life has basically been halved. You go back the last 10, 15 years. So they're getting less oil. Ultimately, there's going to be less lifetime in these, and they're going to have to find other ways to get it. So it's going to keep the entire landscape very tight for the foreseeable future.
All right, Bill Baruch, we have to leave it there. President of Blue Line Futures. Thanks so much.
Thank you.
The final minutes here of the trading day. We'll be right back with the closing bell. And that's the closing bell on Wall Street. Let's do a check of the markets here. All three of the major averages eking out gains. Bit of a reversal here for the couple of the major averages in the final hour of trading. The Dow closing up just around 26 points. S&P holding on to its gains, up about 0.6%. And the Nasdaq, the leader of today's trading action, big tech, one of the outperformers. You're looking at the Nasdaq closing up just about 1%. Well, let's take a look at where shares of U.S. Steel closed on the day. The company is saying that it's getting a lot of interest, of takeover interest, already declining an offer from Cleveland-Cliffs over the weekend. Within the last hour, S-Mark announced an offer of $35 a share for U.S. Steel, really trumping the offer from Cleveland-Cliffs that had been put out over the weekend. We're seeing some of that reaction within the stock, Akiko, of U.S. Steel today, closing up just about 36%. But certainly will be interesting to see how all of this plays out. Cleveland-Cliffs earlier in the day saying that they are still confident that their takeover offer will succeed because they do have the support of a key union here at the United Steelworkers Union. But again, this offer here from S-Mark showing that there is a heck of a lot of interest within the space.
Yeah, S-Mark, by the way, run by a former U.S. Steel executive. But as we see this all playing out, I mean, no question, it looks like this is all shaping up to be a bit of a bidding war for U.S. Steel. And that's why you're seeing those shares moving higher. No matter where this or how this plays out, it will, no question, sort of mark a dramatic shifting of the landscape within the steel industry in the U.S. When you think about the space that we are watching here, I mean, Cleveland-Cliffs, obviously a leader when it comes to flat steel. We're talking about steel that's been used in products like cars. And S-Mark as well competing in that space. But, it'd be interesting to see ultimately, how that M&A breaks down, because to your point, Shauna, earlier, there's also questions about antitrust and, whether, in fact, if there's any deal that's announced, how much of that would actually go through. But also the U.S. sort of trying to join forces in order to compete on a global level with those giants coming out of China as well. We're watching shares of Walmart, the stock closing down on the day after hitting a record high earlier in the session. Evercore putting the stock on its outperform list heading into earnings, and Stifel, who has a hold on the stock, raised its price target to $167 a share. No question, there is a lot of optimism, a lot of expectations riding on these numbers coming out from Walmart. But Shauna, in many ways, it does line up with what we have heard over and over about the American consumer right now, how cautious they are turning, how they're turning away from discretionary spending, really spending on core products here, like fresh foods. Walmart positioned from a place of strength when you consider all those factors.
Yeah, and I think that story is also told just within the analyst action that we saw today. You mentioned Evercore adding Walmart to their outperform list, the price target raise that we got there, and that contrasts to some of the price target cuts that we got for its rival Target today ahead of their results, which are also later this week. Piper Sandler cutting their price target on Target. But when it comes to Walmart, Akiko, you're exactly right. Just given their strong position right now, given the fact that there has been such a massive focus on value pricing, obviously a focus here that gives a Walmart an edge within this category, really positions it as a winner here heading into these results. Evercore, which did add Walmart to its outperform list, expecting a beat and raise quarter, basing that on strong traffic. Also, they expect to see margin recovery. So we'll get those results later on this week. Okta has also been a trending ticker on Yahoo Finance today. The stock getting a double upgrade from Goldman Sachs. The analyst saying that the tech company could see a turnaround in subscription growth and stabilization of its workforce segment. We're looking at gains of just about 1% for the day. But when it comes to that subscription growth here, Goldman saying that they expect that acceleration in revenue from 14% in the second half of fiscal year 2023 to 15 to 20% in 2024. They also see Okta taking a larger share from more legacy vendors here. So given the underperformance relative to some of its peers since the start of the year, the stock only up just about 5, nearly 6%. Goldman Sachs at least sees a turning point here for Okta going forward.
Yeah, looking at that price target up from $77 a share to $91 a share. You talked about some of the competition coming in from legacy players. Goldman Sachs specifically saying we believe competition from Microsoft will remain an overhang on the stock, but we reflect this in our bull case scenario by continuing to discount Okta's multiple by 30% relative to peers. A number of factors there driving this. You talked about subscription growth, stabilization in the workforce segment, but also some new products that they have introduced to really ramp up and drive additional revenue. Well, PayPal is finally announcing its plans to replace CEO Dan Schulman. The company naming Intuit executive Alex Chriss as its next chief executive and will take over on September 27th. Joining us now is Steve Vigor, Argus Research Director of Financial Services Research. Good to talk to you today. Give me your take here with Alex Chriss now being tapped to run the company. What does it mean for PayPal's turnaround?
Yes, hi, Kiko. I think this is a good fit. The more I read about Alex Chris's background, the more I like. I think his the stint at Intuit and integrating acquisitions and the focus on small businesses and of course they do have some payment capabilities as well there. All lines up to be a pretty good fit. So I think the move today, the roughly 3% increase in the share price today is appropriate. I think it's also a bit of a sigh of relief that Dan Schulman, his replacement, has been found. The company has been through some executive shakeups here. They had a CFO, of course, that left for Walmart. They replaced him. He was at a very short stint and then out for medical. And the investor relations director has been filling in there. So, it's been a bit of a void here. And I also like the fact that Schulman will be around through May of next year to make for an easy transition and hopefully a faster learning curve.
Steve, what do you think the top priority needs to be for Alex Chriss? Because he's taking over at a time which is pretty challenging. We have a softening consumer. We also know that PayPal has already been undergoing some cost-cutting measures. But what do you think needs to be at the top of the list as we talk about getting PayPal and strategizing that company here for the future?
Yeah, sure, Sean. I think the focus is what you're mentioning there. They have a lot of competition in the payment space that they have to watch out for. They have to be continue to be very innovative, and PayPal has been on a number of fronts. They've had some struggle with margin expansion here as they focus more on kind of the back business than the payment button business, which is a little bit more lucrative for them. So all of those are key focuses. They did outright state that the cost cutting was coming in advance of a new CEO, so we would not have to kind of come in with what I wouldn't call a bloated cost structure here, but just a little bit more efficient. One could say maybe they overhired a little bit during the pandemic when everything was surging in terms of digital payments. So I think all of those things are going to have to be a focus for the new CEO here.
Steve, who do you think poses the biggest competitive threat to PayPal right now? Apple Pay, that's one that's been raised a lot, but there's certainly a lot of other competitors. This is a space that is much more crowded, or has become much more crowded over the years.
Absolutely, yeah. The big players. You still have Square. Of course, they focus more on the small and micro merchant business. You've got just outright Visa and MasterCard. You've got bank cards. You've got Apple Pay. You've got Stripe. You've got all the affiliations with buy now pay laters, which are taking share. PayPal has their own, so they're being competitive in that space. It is a crowded and competitive landscape. But the thing to remember about PayPal is that they're unique in that you can both be paid and pay and be paid on the platform. You can transfer money with Venmo. You can use cryptocurrencies now. Of course, they had some innovation there last week. So I think they have the name brand. They're certainly the platform that is most prevalent as a checkout button as well, the number one there. So they have a lot of key competitive advantages. I think that certainly make them very competitive in the space and able to grow not just in the payment space because of their strategy, but the tailwind of the secular tailwind that we have in terms of more payments being migrated to digital, away from cash and checks and the like.
When you think about PayPal's stock, this is one that has seen steep declines. We were saying in 2021 that peak was $360 billion in terms of the valuation of the market cap of the company, now at roughly $70 billion. You talked about potential upsides here. What do you think is going to be the big catalyst?
Yes, well, of course, 2020 and 2021 were big years in the digital payment space. You had an acceleration of that digital migration during the pandemic, and I think obviously that pulled forward a lot of growth in those years, and now they're paying for it a bit with more sluggish growth this year and next. Although I will point out that earnings this year should exceed the prior peak of 2021. So in terms of valuation, I think you're looking at, a stock that has a kind of a mid-teens growth is a fairly durable number to expect from them. I apply about a little over one peg or 1.1 peg, so about an 18 PE, and come up with an $88 target price, which indicates the shares are about 30 to 35% undervalued at this point. So I think the catalyst here, a few things that have held the stock back, including the CEO replacement, the need for a permanent CFO still at this point, and just start executing on that, get the lower cost structure in place, and start executing on the earnings growth trajectory that they had previous to the pandemic.
Steve Vigor, Argus Research Director of Financial Services Research. Good to talk to you today. Appreciate the time.
Thank you.
As we get into retail earnings season, Bank of America making a bullish call on consumer discretionary stocks. Yahoo Finance's Josh Schaefer is here with the details. Josh, what are we learning?
Yeah, Shada. So Bank of America coming out today and basically saying that the stock market is not currently pricing in for consumer discretionary stocks the narrative that we've been talking a lot about when it comes to consumers. We've been talking a lot this summer about the resilient American consumer, and Bank of America's economics team has been out talking about that as well. You remember last week we talked about the fact that Bank of America removed their recession call, right? So they're now expecting GDP growth through the next couple quarters. Well, when the strategy team takes a look at that and thinks, well, what does that mean for stocks? It's probably not as bad for a sector like consumer discretionary as one might have originally thought. And then when you think about what's going on with the Fed and the fact that there might not be a recession and we might finally be at the end of this rate hike cycle, when you take a look at how that's impacted consumer discretionary stocks over the course of history, when we come out of rate hike cycles, consumer discretionary has done very well. You can see those are the circled parts in red on your screen there. That's how consumer discretionary has done after a Fed rate hike cycle. Pretty bullish look right there. And then I saw several strategists highlighting this actually now that we're finally kind of toward the end of second quarter earnings. When you take a look at sectors, whose earnings have been revised up the most? Guess what? Consumer discretionary. Coming in at 20%, you can see none of the other sectors even really that close there. So basically saying if the consumer is as resilient as we think and can continue to find a way to spend, it's probably good for the consumer discretionary market because we might never see that full slowdown that we had expected at one point this year.
Well, we will see. We'll get a good look at the consumer with several earnings reports that are on tap this week. All right, Josh, thanks. Well, coming up, shares of Hawaiian Electric closing the day in the red, selling off amid power line concerns. Also a new lawsuit. We're following the latest developments on the wildfires in Hawaii when Yahoo Finance returns. We're following the latest developments on the wildfires in Hawaii. Shares of Hawaiian Electric plunging more than 30% on the day over concerns that its power lines may be linked to the deadly fires. The utility coming under scrutiny that it did not turn off power despite warnings of dry and gusty winds, which could cause a fire. Several lawsuits have already been filed, but officials have not yet determined what caused the fires on the island of Maui. Meantime, the death toll rising to 96 people, and the expectation is that number will continue to climb. Anjali Kamlani is here with the latest on all of that. Anj.
Thanks, Shauna. Yeah, as we know, the death toll now at 96, and officials do expect that number to rise in the wake of search and rescue operations, or rather now leaning more towards just search operations around the Hawaiian island. To date, we know that more than 2,700 structures have been decimated, leaving a destruction total of about $5.6 billion. FEMA's on the ground. The United States Health Department has already declared a public health emergency. All of this to say still ongoing efforts more than about a week later after the fires first started last Tuesday. We know, of course, in addition to those, you mentioned the electrical company, in addition to the mitigation efforts being under review, the governor of Hawaii has also announced a review for the warning systems, one of the largest in the world, that residents say did not go off at the time of the multiple fires around Maui. We know, of course, Lahaina, one of the resort areas in the western area, one of the hardest hit, is still being looked through, as well as other parts of the island. While it is unclear what started the fire, we did hear from NASA as well as National Oceanic and Atmospheric Administration officials today telling reporters that these unprecedented wildfires were a result of an ongoing dry spell, along with multiple other factors, including potentially climate change. July, we know we've been talking about the hottest temperatures on record, and that has likely been a contributing factor to what we saw unfold in Hawaii. We do expect another update from the governor around 9:30 Eastern tonight, so we'll likely get more details then.
We will continue to follow the story. Anjali Kamlani, thanks.
Well, in recent decades, changes in the retirement landscape have caused a decline in wealth for certain age groups. For example, late boomers, those born between 1960 and 1965, have seen a drop in their 401k and IRA assets, according to the Center for Retirement Research at Boston College. Here to tell us why and if this will happen to other generations, we've got Yahoo Finance's Carrie Hannon. Carrie.
Great to be here. Yeah, this is a really interesting study that the center came out with, and they looked at these boomers that were kind of the tail end of the boomer generation here, and how they, why they had this. It was, in fact, they told me it was fairly unprecedented, the decline between those that they considered to be middle boomers, which were those born between 1954 and 1959. So here's the deal. What they've discovered, there are a couple of factors that came into play, but the big one was the Great Recession. Now, we may have started to forget about that a bit, but that was between 2007 and 2009, and this is when this age group was between the ages of 42 and 49. And these are peak earning years, right? This is when you're socking away the most for retirement. And this is the first group, this age group, that really was dependent on 401k direct contribution plans versus the traditional pension plan that was prior to this period in time. And so because during the Great Recession, this group, they lost jobs. If they did get their jobs back, it were lower paying jobs, and they simply never got their feet under them again. They never recovered in their savings in these retirement accounts. The good news here is what the researchers at Boston College say is that they think that for Gen X and millennials, things they won't have this big shift as strongly, because the link between work and wealth shouldn't be impacted so much, unless, of course, we would have another Great Recession. But that really was the big tie-in here. And as a result, it's really startling for some in this age group to realize how far behind they are.
So, Carrie, if you're one of these boomers who is behind right now, what can you do to help maybe increase and bump up your assets?
Yeah, this is really critical. First of all, pay attention. Look at your numbers. The best thing you can do is to automatically be contributing to a retirement plan, whether it's through your employer or if you're a freelancer, whatever it is, have it automatically taken out of your paycheck. Try to set it up for auto escalation. So each year it bumps up a certain percentage. And when you set aside your automated monthly or paycheck savings, make sure that's a percentage, not just a number. Because what happens then is if you get raises and those sorts of things, then it continues to grow faster because that's a percentage of your pay. The auto escalation is critical. Be careful with your bonuses, right? We all want to spend our bonuses and have fun, but if you're lucky enough to have a bonus, shove some of that in your retirement plan ASAP and really let that go with you. I also think it's critical to use some of these retirement calculators out there. AARP is a good one, Fidelity, Vanguard. Really go to these, and because run the numbers, it's hard to look at it, but where are you? Are you really, do you have a shortfall? Don't you? I mean, let yourself, if you're in this age cohort, pay attention. And these numbers can either, it can really be an incentive to spend more, to pay more and spend less.
Certainly good tips there. Carrie Hannon, as always, thanks so much for that. Well, coming up, we are checking in on some of the top trending stories of the day. Ali Canal and Josh Schaefer standing by with what to expect. What are you guys watching?
Hi, Kiko. Well, you've heard us talk about this over and over. Elon Musk versus Mark Zuckerberg. Will they or won't they? The fight of the century, but it will happen.
And it sounds like we might have more answers coming to you later tonight. Elon Musk at Mark Zuckerberg's front door. We'll have more next.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined by Praz Subramanian and Josh Schaefer. We have a lot of really good stories today, guys, but I want to start with something that has been dubbed girl math on social media. And I'm going to preface that this is not just a girl thing. Guys do this too. I would explain it, but there's a video that does a really good job. This is a TikTok that caught my attention over the weekend. So I want to play that so you can fully understand girl math.
Here's a list of things that I firmly believe because of girl math. Anything under $5 is free. Anything I buy with a gift card is free. If I buy something but then I return it, I've made money. Going to an event or a concert is free because I purchased the tickets so long ago it doesn't even count. I load my Starbucks app in advance, so Starbucks is free. Anything discounted more than 50% is free, and I am losing money by not getting it. If I'm paying someone back for dinner and I have money in Venmo, that dinner is free. If I don't buy something, if I don't buy a pair of shorts for $50, I've made $50 and I can then go spend $50 on something else. Okay, this one's a little bit weird, but my husband and I share credit cards and a bank account, but somehow every time that he puts down his card with his name on it, that's free and he paid.
I don't know, guys. It just makes sense to me. The Venmo hit hard. The Starbucks app, I do this. I'll load it up for 25 bucks. 2 weeks go by. I still have $5 left. I'm like, oh, I should get a coffee because basically that's free.
That's why it's a good business model for Starbucks, right?
100%. And it's the perception, right? Of if you pay in advance, you don't reap the benefits till later. Also known in accounting as amortization.
Amortization.
Always a tough word for me in my accounting class. But basically,
tough word.
That's what it is.
I got to say, I will say this. It's funny segment there. I like that, but I think that cost per use stuff actually is something that I would actually use. That's how you look at you buy a pair of expensive jeans that you wear a lot to work, wear a lot that you go out. I think it's worth it if you use it a lot. So there's a way to quantify that. The found money, things like that's fun. But I think there actually is some elements there that you can actually use. Girl math works in some instances.
Well, this is what Miles Udland said when we were talking about girl dinner 2 weeks ago. I think he said that TikTok is just giving names to everything that we already did before and making it a little bit funnier. But like you said, Pras, it's kind of something that you've always used. Now, I think some of these aren't actually really cost savings mechanisms, and we should probably be better at them. Venmo, I think, is a perfect example. It does feel like you're not spending money if you Venmo someone, right?
And I know it's all fun here.
Someone puts down their card at dinner and you Venmo them, you don't feel like you went out to dinner. You just use some money off Venmo.
Cash already in your card.
100%.
So it's not taking anything from your bank account.
Every once in a while, you want to be the card person, so then your Venmo gets a little bit fuller, and then you have a stockpile of money in there.
And
so
then
when you go
points,
out, and then you can use it. Yeah.
But there are different tips and tricks that people do. Like when people want to save money, they actually pay in cash because the physicality of it all, actually counting your money, giving it over, there's something to be said, I think, mentally versus when you just throw down a credit card. You don't really understand, I guess, how much you're spending in that moment. Like paying a credit card $2,000 versus giving someone $2,000 in cash.
Right.
I
would argue, though, that you
thing.
go through your credit card statement at the end of the month.
Sure, but that comes later.
And you read it, and then you understand how to proceed for the next month, and that's how you operate.
You might not be thinking that way.
I'm going to buy a Porsche 911 for $100,000, drive it 1,000 times, only $100 a pop. I think that works, right?
I think that works.
All right, well.
I subscribe.
While we're talking personal finance, so let's talk a little bit of student loans. Interesting story today in the Wall Street Journal, talking about how the reinvigoration of student loan payments are going to become due again in October, might actually be taking some folks out of the stock market. And one thing that I found interesting when sort of thinking about this story is, as someone that graduated in 2020 and had a lot of friends that had delayed student loans, a lot of people did really get into the day trading concept of that meme trade and getting excited about it and using Robinhood and things like that. And what I found interesting about it is when you think about the amount of money those people are putting in and you think about what this story is, are we talking about people not putting as much money in stocks and actually impacting the stocks, or impacting a company like Robinhood? It'd be interesting to see if Robinhood's daily users get impacted at all as people start to pull out their little bit of savings, because Robinhood has a lot of accounts that don't have a lot of money in them. It's not a traditional trading account, a brokerage account with thousands of dollars. Some people use Robinhood with a couple $100. And so does Robinhood end up with less daily active users or something? Like, where do you sort of see it play out in the market as people try and save more and go back to paying their student loans? I think is sort of what people are trying to figure out here.
Well, I was kind of surprised that in the journal piece they talked about how 57% of Gen Z, right, has between age 18 to 25 have at least one investment. I was surprised to hear that. Now, what they're talking about here is most of them are investing in cryptocurrencies and individual stocks, which isn't always the best financial move. But hey, with Robinhood, you can actually buy fractional shares. So if you want to buy Apple, you want to buy some Tesla, you can actually do that, and only a little bit of here and there for only a few $1,000s. Is it going to be impacted by the return of student loans? I think for sure. I think for sure you're going to be kind of sucking up some of that money you'd go to play with on the market, goes to paying off some loans. Now, they had a guy in the story, he only had $5,000 worth of loans. I'm like, that's not that bad, man. That's not that bad. I mean, people have hundreds of thousands.
Don't sell your Dogecoin to pay that off, right?
Yeah, well, the guy made money off Dogecoin.
Yeah, right.
Anyway, yeah, I mean, I think it's not. We'll see what Robinhood. Yeah.
For sure. And also, I think back to the pandemic when people were getting stimulus checks, that was going towards investing, things like that. But I got to say, Gen Z, they are really savvy with the investing in the Robinhood. I don't know.
More than I thought, right?
More than I thought. I don't know if it's because TikTok, social media, it is so easy to go on and get advice and tips and tricks. Like my little brother, he was like, you need to have these 3 credit cards, you have to do this stuff. I'm like, oh boy,
I get so many real estate, like, why are you not owning real estate? This is how you do it. And I'm like, I should stack my real estate holdings.
I know,
this is crazy,
it overwhelms me, but I really
doing it wrong.
I think TikTok is a big driver of that. You just learn a bunch of stuff and you have access to it right at your fingertips.
And this goes into girl math maybe, right?
Maybe it's all related.
Speaking of things that we like and maybe don't like, and maybe I'm getting sick of, is the Elon Musk, Mark Zuckerberg feud. It's going on forever. I think Zuck is sort of now tired of Musk sort of being a wuss and not agreeing to a fight. But let's take a look at some of the back and forth here that we've seen across the last few days. I know we have some things that Musk says, I'm up for the cage match if he is, LOL. Zuckerberg says, send me the location. Musk says, the Vegas Octago, whatever that is, the fight will be there streamed on X. Zuckerberg says, why can't we use a more reliable platform? Ooh, big smack there. Musk, I'm lifting weights, preparing for the fight. And then what happens next? Zuckerberg says, I'm ready, August 26th, here's the date. Musk, I'm getting an MRI on my neck and my upper back. I spoke to my...
That was the dagger.
Yeah, I spoke to the doctor. I spoke to the PM of Italy, and then they want to have an epic location for the fight. Yes, and Zuck says, when is it going to get real? Musk says, today, I will drive the Tesla FSD to your house if you get lucky. Answer the door, the fight is on. My takeaway from this is Zuckerberg is actually being, as funny as this whole, and jokey this whole thing is, Zuckerberg says, let's do this.
Oh, he's
Here's
serious,
a date. Let's do this. Right. Musk is the one that's backing out, wussing out. I want to be there tomorrow today.
He's treating this like a joke, like, haha, this is funny, but I feel like Zuckerberg is super serious and is actually a little annoyed.
You're telling the billionaire owner of Facebook, I'll come to your house at a random time to fight you.
But he says he's going to stream it on X. It's all just marketing, earned media, free exposure. That's all Musk is trying to do. And he probably is actually going to stream this on X tonight. And let's be honest, if you're sitting on X,
like
Twitter,
stream him going up to the door?
Well, he's going to stream the full self-driving test. I guarantee he'll stream that full self-driving test. And you're going to get the push notification. And there's a part of you that wonders, is he actually going to go to Mark Zuckerberg's door? So there's a decent chance, at least I'm clicking on it. So you've got to at least give Elon credit there. A lot of the stuff he does, a lot of us find annoying, but he's pretty good at drawing your eyes, right? We've been following it. We're still talking about it. He's kind of a master marketer when it comes to that.
He's the Dave Portnoy of tech.
He literally is.
One fight, it might just be a win for Elon without even having a fight.
Everyone knows the rules.
There you go.
Portnoy refs. Your refs fight, right?
Oh, gosh.
Well, is that it?
I think we're done.
I think that's it, yeah. I got the wrap in my ear.
All right, we'll be back after this break.
Netflix is launching a test of its video game streaming services in Canada and the UK starting today. Yahoo Finance's Dan Halley has the details. Dan, this is still a very limited release, but certainly marks a big step in terms of the company's ambitions in gaming.
That's right, Kiko. This is still a beta. It's as you said, limited. Only certain users in the UK and Canada are going to be able to access it. But what they're going to be offering are two different games. One is called Oxenfree, and the other is Molehew's Mining Adventure. Now, these aren't the most aggressively, graphics-intensive games on the market, but what it does show is that Netflix is moving forward with their gaming ambitions. They already offer mobile games on mobile platforms. If you load up Netflix on your smartphone, chances are you'll see some of the games that they offer there alongside the movies and shows that are already on there. But this is a different kind of animal. This is where you would actually be streaming the game from Netflix servers to your device. The benefit of cloud gaming is that you don't need a powerful system to run video games. You don't need a high-end PC. You don't need a pricey console. You can do it on your TV, your smartphone, your tablet, a Chromebook, an older laptop or desktop, things along those lines. And you can still get high-end graphics and everything that goes along with that through cloud streaming. We see other companies in the space, but Netflix being here really is kind of the one that we were waiting for. Everyone that has a kind of cloud gaming service, whether that's Microsoft or Sony, I generally refer to it as, kind of Netflix style gaming. And now we actually have the Netflix of gaming. We still have to wait, though, to see whether or not they're going to roll out high-end games. AAA games is what they're called, the Call of Duties, things along those lines. But this is a seemingly good start for them.
Dan, how much disruption do you think Netflix is going to bring to this space? And you mentioned some of the players that have already been in gaming right now. Are they going to be able to compete with Netflix now, one of the big entrants within the industry?
Yeah, I mean, look, Microsoft is the leader, bar none at this point. They have their Xbox Cloud Gaming. It's part of their Xbox Game Pass service. You have to get the highest level that they offer. But Sony also has its own cloud gaming offering as well. The difference between Microsoft and Sony is that Microsoft is, first-party Microsoft games that they develop or are developed by studios that they own. They put out the same day that they hit retail on their cloud gaming service. So that's a benefit for Microsoft to really say, look, we are the preeminent cloud gaming platform available. Sony's not doing that, but they are starting to work on getting PlayStation 5 games on their cloud service. There's also NVIDIA and Amazon, by the way. They also have their own cloud gaming services, but it's not easy. Google had tried to run its own cloud gaming service called Stadia and folded that entirely. Now it's potentially looking at putting some kind of cloud gaming in YouTube, according to the Wall Street Journal. But it's not something that is necessarily easy, even for companies with seemingly limitless coffers like Alphabet. So Netflix is going to, really need to prove that this technology works. And, even when it comes to Microsoft and what they have to offer, if there's any kind of slowdown in your internet connection, if you don't have a fast enough internet connection, or there's, a lot of usage in your area and you start to run into lag, then it throws off the entire experience. It's not like where you can sit there, pause it, and let it buffer like you could do with a show or movie. This is a game that you're actively playing. And if you press a button and it doesn't respond properly, that instant on screen, then it's a wasted experience. So we have to see how Netflix manages to do that and what the experience is like to see if eventually they'll be able to do what Microsoft can do. And I think one of the important things to point out just real quick is, Microsoft, you can use your Xbox controller. You can also do that with the Mac or PC. You can plug in your Xbox controller. Same thing with Sony. You can do it on your Mac or PC with your PlayStation controller. Netflix isn't offering a controller. They're letting you use your smartphone. So I don't, it's going to be tough if they end up going into, more hardcore gaming, more AAA games, to be able to do that with a smartphone controller. So we'll just have to see if eventually they provide support for, peripherals like an Xbox controller or a PlayStation controller down the line. But this is, as I said, this is a big step for them. And if it does end up working out, we could see a whole new revenue stream for them down the line.
Dan, I have a feeling some of those challenges you talked about with gaming drawn from personal experience, right?
Just a little. just a
little. Points to a lot of frustrations there as well, though. Dan Halley, thanks so much as always.
A steel sector shakeup. Shares of U.S. Steel soaring today after it rejected a buyout offer from rival Cleveland-Cliffs. The company saying the $7.3 billion offer was, quote, unreasonable and that it is reviewing strategic alternatives. Well, steel production company Esmark also announcing earlier today an all-cash offer for U.S. Steel at $35 a share. Another steel producer moving on that news is Nucor. Well, Yahoo Finance's Brian Sozzi recently caught up with CEO Leon Topalian, talking to him about Q2 earnings beat and also discussing the sector at large. Let's take a listen to what he had to say.
You know, Nucor's continued position for growth is in our platforms for our investment and capital allocation are paying dividends for our shareholders. You know, we earned $5.81, as you know, EPS for the quarter, $10.26 for the year. So it's our second strongest start of any year in our history. So again, with all the looming fears and talk about recessions, Nucor continues to take care of our shareholders, our customers, and our team. Brian.
Take us through this earnings report, Leon. What stood out to me, steel mill profit margins up. Why would that be the case?
You know, again, underlying demand continues to be very resilient. So we're seeing sectors like automotive, energy, within oil and gas, renewables, the advanced manufacturing, data centers, all continue to be areas of strength. And Nucor is one of the most diversified steel producers in North America, is well positioned, well poised to capitalize on that. And again, you're seeing that kind of flow through in our earnings portfolio. Free cash flow is generated, EBITDA generated. And that, you know, again, is a part of a long-term investment strategy.
Within those industries you just mentioned, where are you seeing some of the strongest demand? And are you seeing any signs of slowing anywhere as it pertains to the top line?
Again, thinking about Nucor's breadth, right? We're the largest steelmaker in North America, the most diversified. So there are parts of the portfolio that are not as strong as the 2020 peak years. But again, 2022 is it has to be viewed through the lens of context. So it was the peak year, record highs across the board. And so, for example, in warehousing, still very strong, but off 15, 16% year over year. However, pre-pandemic, it's up 60 or 70%. So again, the segments of that remain incredibly resilient, but automotive continues to be very strong. The advanced manufacturing in our warehousing data centers year over year are predicted to be up. So we're seeing that renewables, offshore wind, oil and gas continues to be an area of strength. So those are the markets that, again, are showing signs of improvement or strengthening.
Within your outlook for this year, Leon, do you see a rebound happening in the U.S. housing market?
You know, that's a great question. And like everyone else, we continue to watch. And, you know, when we started 2023, all the pundits were talking about the recession. And again, we'll see if that comes or not. But GDP forecast in Q1 was predicting a Q2 GDP of 0.3, obviously much, much stronger. I think that continues throughout the rest of the year. How much of a rebound we'll see, you know, I don't want to predict right now. But again, I think there's some consumer spending continues to be strong. And so we're seeing sectors of this economy that remain very resilient, on top of which there's another aspect of that we've not seen, certainly in my time in steelmaking, and that is the amount of money being put into this economy through legislation. The CHIPS and Science Act, IRA, infrastructure are things that, in spite some interest rates and some, again, talk of a recession, remain incredibly robust and are bringing things into our sector that, again, Nucor is well positioned and capitalized to execute on.
No, you brought up some very good points, and I want to get to that. But in terms of just the costs of doing business, are you confident in saying that inflation has peaked? We're hearing that tone start to emerge this earnings season. I think a lot of investors haven't heard that from CEOs in 2+ years. Can you say that?
You know, look, I would tell you that we're a margin business. And so at the end of the day, we're not immune to some of the influxes of the supplies and services, but most of our uses are coming within the United States or certainly within North America. So we did not have the exposure to other nations and other countries like some manufacturing sectors did. So I think by and large, that's tamed and certainly, again, part of our mix as we predict and estimate for the rest of the year. We think it'll be a good, very solid year for Nucor.
You mentioned legislation, and I think that is very important to the steel industry. As you take a step back, you had the Trump administration put tariffs on China steel. That seemingly good for U.S. steelmakers. But then, as you just mentioned, we had all this stimulus from the Biden administration from various different avenues. Which administration has been better for your business?
You know, again, Nucor has been well positioned. We've been advocates for fair trade, not free trade, for a very, very long time in our company. And again, you've seen 5-6 years ago, the industry only had about 50 or 60 cases that we had won against bad actors that were illegally dumping or subsidizing their steels. Today, that's more like 120. So we have great protections, and both sides of the aisle have been very supportive of the industry, including President Biden, Secretary Raimondo, Catherine Tai, our USTR. So there's strength there. And again, I don't think it can be overstated. You know, just the CHIPS and Science Act alone, to date, there are 34 semiconductor facilities planned to be built in the United States for a total cost of around $374 billion. That is a massive influx of steel demand, steel intensive buildings that at Nucor is again continued as one of the safest, cleanest, most productive steel makers on the planet to serve and continue to serve our customer base.
Is it fair to say then, you know, because of those tariffs, that China is no longer dumping steel in the U.S.?
That's correct to say directly. But again, the sort of whack-a-mole game continues to be played. And so those steels are moved to other nations, potentially manufactured or fabricated and having some downstream process that would remove them from the trade barrier or case that they were originally cited. So do those steels move to Vietnam or other nations? Do they move to Mexico or Canada and then into the United States? So our advocacy, our vigilance, and making sure the administration is aware of the policies and the things affecting our nation in a world of oversupply will remain part of our focus for decades and decades to come.
In terms of the stimulus plans infiltrating the U.S. economy, what inning do you think we're in, and how do you think they shape your earnings in 2024?
Yeah, we're really at the front end of that, but it's happening. We're seeing on the order books now, those orders are generating actual production in our plants today. But again, we're on the front end of that. But the stimulus you talked about, they're 10-year investment cycles. So we're going to continue to see that move up. And again, very construction intensive. So as you think about the products that we make and the rebar, plate, sheet grades, steel beams, joist, deck, metal, insulated metal panels, all of those things are uniquely brought together by our solutions group, and will continue to help serve those end markets incredibly well, and ultimately reward our shareholders with continued improved profits.
That was Nucor CEO Leon Topalian, along with our very own Brian Sazi. Well, coming up, it's closing time here on Yahoo Finance. We'll recap the top stories of the day and get you set up for everything you need to know tomorrow. Stay tuned.
Let's take a look at a couple of trending tickers here after hours. We got to start with DR Horton, Lennar, and NVR. The reason why these three names are up on your screen is that Warren Buffett's Berkshire Hathaway took positions in all three of these companies. We're just getting the details from the most recent 13F filing. We know home builders has certainly been rallying here in recent weeks, off to a very strong start to the year. Taking a look at DR Horton, that stock up nearly 40% since January 1st. When we take a look at a one-year chart, they're up just about 54%. So Berkshire Hathaway now owning 5.97 million shares of DR Horton, valuing that at $726.5 million. NVR, this is a parent company of Ryan Homes and NV Homes. We're looking at gains there as well, up just about 1% in extended trading over the last year. We've seen the stock rally just about 38%, and Lennar has been another winner within the home builder space. Certainly, we have seen some outperformance there. Also taking a look at two stocks that Berkshire Hathaway increased their positions with. First, Capital One raised their holding by 26%, now accounting for just over 3% of the outstanding shares. We're looking at gains of just about 0.6%. And Occidental Petroleum, a name that has been associated with Warren Buffett, with Berkshire Hathaway in recent months, given the stake that we've gotten there. And if you can take a look at Occidental Petroleum, the chart that we have seen since the start of the year, it is up just about 3%, so bucking some of the pressure that we have seen in the wider space. But Berkshire Hathaway now owning about 25% stake within the company. And taking a look to that board that we just had up on the screen there of Berkshire Hathaway's top holdings, these have all remained unchanged. He has not adjusted his position here within these companies, but Apple, Bank of America, and Amex among the top holdings there for Berkshire Hathaway. Let's round it out with taking a look at Amazon. Some news breaking within just the last couple of minutes. Another executive change at the company. This time, hardware chief Dave Limp is retiring. He's been with Amazon for just over 13 years, about 13 and a half years now. Limp overseed Echo. He oversaw Fire TV, tablets, among many products there for Amazon. Now, this division was one of the ones that was very hard hit in the recent layoffs that Amazon has announced. Year to date, Amazon shares up just about 67%. Not a huge change here in extended trading, but again, just another executive change for Amazon under CEO Andy Jassy.
Well, it's closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. President Biden speaking out on tense negotiations between the United Auto Workers Union and the big three car makers. Biden calling for a fair agreement that would avoid a strike, which he says would be painful if it happened. His comments come just 1 month before the September 14th deadline. UBS is set to pay $1.4 billion in settlement for selling toxic mortgages before the Great Recession. The Justice Department announced the deal today that stems from a lawsuit filed in 2018. The DOJ alleges the bank defrauded investors by selling mortgage-backed securities that it knew were problematic, but sold them anyway. In a statement, UBS described the settlement as a legacy matter. And PayPal is naming Alex Chriss as its next CEO. Chriss will replace Dan Schulman on September 27th. He joins PayPal from Intuit, where he led the QuickBooks business. Schulman is staying on at PayPal as a board director.
Time now for what to watch on Tuesday. Home Depot is kicking off retail earnings for the week. The company's results coming amid softening home improvement trends. Same-store sales are expected to decline due to weaker consumer and a drop in lumber prices. On the econ front, retail sales for July will be released at 8:30 a.m. Eastern Time. Sales are expected to edge up 0.4% from the previous month. The report following a warning from the National Retail Federation that growth in consumer spending is slowing. And turning to the Federal Reserve, Minneapolis Fed President Neil Kashkari will be speaking at the API Group Controllers Conference. Investors will be listening for any clues about the path forward for interest rates ahead of the Jackson Hole Economic Symposium next week. That does it for us today on Yahoo Finance. Be sure to come back tomorrow, 3 p.m. Eastern Time. We've got all your coverage leading up to and after the closing bell. We'll see you then.